Good morning, everybody, or good day if you're one of our friends in New Zealand. Welcome to our webinar today. So this is the final IFRS webinar for 2021, and we're looking at foreign exchange complexities. As always, or usually, Kevin would be presenting this webinar with me. However, it's that time of year. Kevin just sent me a message. He's been caught up in a client meeting, and therefore I'll be presenting this on my own today. Kevin did say, I should say, I hope you all have a wonderful festive season. And if you celebrate Christmas, a Merry Christmas. And he'll be back in January for our 2022 webinars. Now, that is a good introduction to the following. So from next year, we've just scheduled our webinars for next year. I've given you a link there to go to our website to register for those. We're kicking it off already in January, just after Australia Day. We've got what's hot and what's not in 2022. And then on the 16th of February, we're looking at the interaction between financial statements and sustainability or ESG reports. So how do we have this holistic integrated communication with stakeholders? In March, we're looking at getting ready for IFRS 17, which is insurance contracts. Important, IFRS 17 is not just for insurers, but actually for all entities that potentially have insurance elements within the contracts they enter. So if you want to register for next year's webinars, they're up on the website and they are ready. So you can register, please do so. The other thing that I should say is if you would like to register for our monthly accounting news, I've given you a link to a page on the website where you can do that. Somebody's contacted me recently and said they didn't know where to register for the accounting news. So there's the link, and that's what it looks like. You know, you can tick what you're interested in. Is it in accounting standards training or information about that? Our normal IFRS services, our monthly accounting news, maybe BDO lead, etc. And we'll communicate with you around those aspects. So you can register for our webinars for next year, and you can register for our monthly accounting news. Now you will see that our accounting news will be circulated to all people that are registered tomorrow. So just in time for Christmas. So on our accounting news. So today we're looking at foreign exchange complexities, and in our agenda we've got 6 particular sections. We're looking at an introduction, so a bit of a scope and objective of IAS 21 or AASB 121. We're looking at determining functional currency. In the third section, we look at reporting foreign currency transactions in a foreign currency. In the fourth section, we look at how do we translate a foreign operation. In the fifth section, we look at presentation currency. So if you've got a functional currency that's different to your presentation currency, how do you do that translation? And then finally, we end up with some disclosure requirements in IAS 21. I'll just pause there for a moment. Because I'm all alone today, I don't have Kevin here to check the sound and everything for me. Could you please maybe just pop in the chat box or the question box whether you can hear me, whether you can see the slide, whether everything is working well. That way we know we're good to go. So in the question box, in the chat box, maybe just a thumbs up. Let me know whether everything is well, whether you can hear well. Fantastic. So Katerina, thank you very much. That's wonderful. I just wanted to do a double check because I'm alone. All right, fantastic. So IAS 21 or AASB 121 is quite an important standard. It's been around for quite a while, but it's an important standard because we know the world is getting so much smaller. Entities do not only operate within the countries that they are based or where the head office is based, and there's a lot of transactions globally. We also know entities might have a head office in Australia and they could have subsidiaries anywhere in the world. And how do we translate all the trial balances of all those different entities into Australian dollar to potentially prepare and present consolidated financial statements in Australia? Um, so IAS 21, AASB 121, an important standard. And there's some quite complex things in there. So we'll do a high-level overview of IAS 21. So if we look at the scope and the objective, IAS 21 outlines how to report the effects of changes in exchange rates in the financial statements, and it's arising from three different things. The first one in blue there, transactions not denominated in a foreign currency. In yellow, we've got interest in foreign operations. And then finally, in the maroon, translation of financial statements into a foreign currency. So three particular things outlined in the standard. Now, I think it's important that we differentiate between transactions versus translation of financial statements. So on the left-hand side, the transactions would be you have specific transactions in a foreign currency. So it's maybe a foreign exchange, a loan in a foreign exchange, or maybe a purchase from overseas and you have to pay in the currency of that country. So it's particular transactions. Translation of financial statements in its totality would be where you potentially have a subsidiary in another jurisdiction or another country. They prepare financial statements in, let's say, New Zealand dollar, but because you want to prepare consolidated financial statements in Australian dollar, the first step would be to translate the financial statements of that subsidiary from New Zealand dollar to Australian dollar in order to do a consolidation. And then obviously in the middle, we have foreign operations, which are not only subsidiaries, it could be associates, it could be joint ventures, it could be branches. And how do we account for those? So quite different things covered in IAS 21. Now, I made a bit of a song and dance between the difference between transactions and translation, because there's a particular set of rules for individual transactions and rules on what do we do with exchange differences when we translate or convert these transactions. And there's a completely separate, different set of rules for the translation of financial statements, and also different rule around what do we do with those exchange differences. So don't get confused between the two. There are individual transactions as opposed to translation of whole sets of financials. The other thing is interesting is if we look at the three parts of IAS 21, it actually often starts, or entities often start on the left of the screen, where they have a small number of transactions denominated in a foreign currency. And then progressively, increasingly, they have more transactions in that foreign currency. So over time, those transactions in those foreign currencies become more and more. And then you get to the middle of the screen, or that dot in the middle, where we're starting to get to a situation that so many of our transactions are potentially incurred in a foreign currency, that the functional currency of the organization potentially changes, let's say from Australian dollar to US dollar. And then over time again, because you now have a functional currency potentially of US dollar, and over time you get more and more investors that are potentially located in a foreign jurisdiction, finally, there's maybe now a need to also present financial statements in a different currency. So maybe we now want to present financial statements in US dollar. So it could be a slow process where initially you've got an entity in Australia that prepare financial statements in Australian dollar, functional currency, Australian dollar, maybe a few overseas transactions where you settle in a foreign currency. Over time, it changes. And ultimately, you might end up with a set of financials prepared in a different currency. So that's just maybe a little bit of the linked potentially to the growth of an organization. So the first step. Now, when we look at IAS 21, one of the critical things, and really the first thing for any organization to think about, is how do we determine functional currency? So if you look at your functional currencies, as I said earlier, some entities transact in foreign currencies. They maybe buy and sell goods and services from overseas. Maybe you import goods from different countries, and important, you settle in the currency of those countries. If you're an Australian entity, you import, but you settle in Australian dollar. We don't run into foreign exchange issues. It could be that you make investments overseas, over time. You could potentially raise debt and raise equity funds overseas. So over time, more and more the entities more and more exposed to foreign exchange gains and losses. And therefore, more and more they have to convert those transactions back to Australian dollars in order to put it in the financial statements. So, it's always an issue. At what stage do you have so many transactions overseas? And maybe you buy all your goods overseas, maybe you make all your sales overseas, maybe you make a lot of investments overseas, you raise funds overseas from foreign investors. That at what stage would your functional currency, Australia dollar, potentially tip over to become another functional currency? All right, so functional currency is an important issue. The other thing to remember is functional currency is not a choice. It's not an accounting policy choice. It's at all. You look at facts and circumstances of your organization. You look at the requirements of the standard, and then you determine your functional currency. There's judgment required. Absolutely. You have to apply your judgment to decide on the appropriate functional currency, but it's not a choice. And I think that's really important. So if we look at that definition of functional currency, paragraph 9 defines functional currency as the currency of the primary economic environment in which the entity operates. So the primary economic environment, another way to put it, would be the currency in which the entity generates cash and the currency in which the entity expends cash. So that's a simple definition. So if you've started in Australia, it could be that initially you generate all your cash in Australia and you spend all your cash in Australia. So your functional currency in that situation would be Australian dollar. However, as we've said earlier, it could be that your business grow and develop, and therefore you have to reconsider what your appropriate functional currency is based on facts and circumstances. So there are 4 steps on how to do this. And the first step would be to consider the primary indicators of functional currency. Then, in step 2, you could consider additional supporting indicators. In step 3, you consider additional supporting indicators when you are looking at the functional currency of a particular foreign operation. And then in step 4, we discuss what if we are indicators that are mixed and the functional currency is not obvious, what then? You've gone through all of these steps and it's just not obvious. Then we have to apply our judgment. So let's look at each of these steps. Now, in step one, when you look at the primary indicators of a functional currency, there are three things to think about. First one would be, what currency would what factors would mainly influence your sales price for your goods and services? So if those factors are Australian factors that impact your sales price, then you would say your functional currency, or it's an indicator that your functional currency would be Australian dollars. So what would mainly influence your sales prices? Factors within Australia or not? You would also, in the second one, the country whose competitive forces and regulations mainly determine sales price. So, in which country would regulations impact this? And we know in Australia we have a lot of regulations. If those regulations impact the sales prices of your goods and services, and impact, therefore your organization, your functional currency would be Australian dollar. And then the other thing would be, what would mainly influence your labor, your material, and your other cost of providing goods and services? So the first one is looking at influences on sales price. The second one, again, sales price, competitive forces around sales price. In the third factor, we look on the other side, and it's the things that would influence labor costs, material costs, and other costs to enable you to provide these goods and services. We're looking at sales prices and costs. What factors would impact those? I think what's important, and this is something that I would say is one of the big traps in IAS 21 when you look at determining functional currency, is if it is obvious what the functional currency is, after you've looked at these primary indicators that we've looked at on the previous slides, the three indicators around sales and costs, if it is obvious what that functional currency is, then there's no need for you to go any further and look at additional supporting indicators. You would stop there and say, I know what my functional currency is. That's important. Sometimes people go on. So maybe it's obvious that your currency or functional currency is Australian dollars, but instead of stopping, people go on and they also look at the supporting indicators. And maybe the supporting indicators point to a different currency. And then people say, now I'm confused. The first indicators look at Australian dollars. The supporting indicators maybe point to New Zealand dollars. What do I do now? Now, in that situation, you shouldn't be confused, because if it was clear after the initial step, you should have stopped and said, Aussie dollar is my functional currency in my example. Okay, if it wasn't clear, then you'll say, okay, let's look at additional things to help clarify. In which currency would funds from financing activities be generated? So if we issue debt, if we issue equity instruments, in which currency would we do that? So that could help us. And then also another supporting indicator or additional indicator would be, what would be the currency in which receipts from operating activities are usually retained? So if we're going to keep some of these, some of the cash from operating activities for future dividend declaration, etc., in what currency would we keep that? So that's another way to look at it. The other thing to look at, or to consider these additional supporting indicators, would be around discussions of the functional currency of a foreign operation. So you'll say, okay, I've got a foreign operation, which could be a branch. It's not only subsidiaries or associates, etc. It's not necessarily a separate entity. A foreign operation is not necessarily a separate legal entity. And what are the things we would think about? So we would first of all think about whether the activities that are carried out by that foreign operation are carried out as an extension of the reporting entity, or you know, is it an extension of the reporting entity, meaning they have no significant degree of autonomy, for example. Um, the other alternative could be that they're not just an extension of the reporting entity because they've got a significant degree of autonomy. So we have to look at that. Um, we will also look at the transactions with the reporting entity. So the reporting entity being our entity maybe in Australia, where we've said it's got a functional currency of Australian dollars. We have this branch in New Zealand, and we want to work out what is the functional currency of the branch. So in the second bullet point here, we would say, are there a lot of transactions between the branch in New Zealand and the reporting entity in Australia? Is there a high proportion of transactions or not? If there's a lot of transaction, or if all of the branches transactions would be with the reporting entity, of most of it would be with the reporting entity, it could be an indication that they have a similar functional currency than the reporting entity. Also, we'll look at whether the cash flows of this foreign operation directly affect the cash flows of the reporting entity, and also whether the cash flows of that foreign operation is sufficient to service their existing and expected debt obligations without getting funds from the reporting entity. Because if that is the case, one could argue potentially that their functional currency would be New Zealand dollars. Because they have enough cash, they generate enough cash, so they can service their debt without us constantly giving them money from Australia, for example. So it's all about how linked the two are, and that will have an impact on the functional currency of that foreign operation. Now, these indicators are only about the functional currency of that foreign operation. These indicators don't affect the functional currency of the reporting entity, which in my example is in Australia. Then in step 4, when we look at these indicators and these indicators are mixed, or the functional currency is not obvious, we have to use judgment. So management uses its judgment to determine the functional currency that most faithfully represents the economic effects of the underlying transactions, the events and conditions, and it most faithfully represents the economic effects. There could be different currency that could represent the effects, but we have to pick the one which is in the judgment of management most appropriate. I think the other thing to consider when we look at functional currency, which could be a few tricks again, is that each entity would determine its own functional currency. As a standalone entity, as an entity with a foreign operation, so a parent will look at its own functional currency. And the foreign operation, which could be a subsidiary or a branch, will look at its own functional currency. So every entity in the group, or even an entity where we've got a main activities in Australia and a branch in New Zealand, each of them will look at their own functional currency. And it's important that the functional currency of the parent may differ from the functional currency of an operating subsidiary. Very possible. So it's important that we consider that. The other thing that I've put on the bottom of this slide is just a reminder. We've stepped through these criteria and the things to think about and the things to consider when you determine functional currency. But there's something that was not there. So IAS 21 does not require an entity to consider local statutory and tax requirements when determining functional currency. All right, so if you start to bring that into the discussion, that's not appropriate. We have to stick to the requirements and the indicators as outlined in IAS 21. And I'll just repeat, functional currency is not a free choice. It's based on facts and circumstances, analysis, judgment of management. Now, it might be a good time to also flag that functional currency of an organization can change. And that's what I've tried to illustrate in an earlier slide, that over time, the situation, the facts and circumstances around an entity can change, and therefore we have to reassess and reconsider the most appropriate functional currency. So in paragraph 13, it clearly says that an entity's functional currency reflects the underlying transactions, events, and conditions that's relevant to it. And once determined, it's not changed unless, which means as soon as you see these, you have to change your functional currency. There's a change in those underlying transactions. So you have more and more transactions overseas. There's a change in events. There's a change in conditions. So the practical issue really is, what would constitute a change in the underlying transactions? What would constitute a change in the events and a change in the conditions? And quite often, this change happens slowly over time. It could be that as a result of COVID-19, you've made a significant change to your transactions, your events, and the conditions under which you operate. Maybe previously you've imported a lot, exported a lot. Maybe you're now more focused on Australia. So maybe in the past, you had a functional currency that's not Australian dollar, but because you now focused on the local economy and your transactions are local, maybe your functional currency should now be Australian dollar. We also see a change in functional currency often when we look at potentially junior explorers. So a junior explorer could potentially initially say that we spend all our money in Australian dollar, and it's all, and we don't have sales, so it's all about the cost, and we incur our costs in Australian dollar. However, when that junior explorer find the mineral that they can extract and sell overseas, usually those sales could happen in US dollar. And often when they start with production, the equipment that they use are purchased from overseas in US dollar. They pay US dollar to operate those mines, and maybe they get expertise in from overseas that they have to pay in US dollar. So at that stage, one could argue that the functional currency of that junior explorer used to be Australian dollar, and maybe now that it goes into production, it becomes a US dollar, as an example. So we have to be aware of it. It's not a set and forget. We have to consider whether transactions, events, or conditions have changed. If we have a change of functional currency, we'll apply the translation procedures applicable to those new functional currency prospectively from the date of the change, which means that we'll translate all items into that new functional currency using the exchange rate at the date of the change. So we might have had a trial balance previously in functional currency Aussie dollar. At the date of the change, we translate all of those into the new functional currency of US dollar. And we apply the US dollar functional currency prospectively going forward. In the next section, I would like to look at the transactions. You've got let's say for illustration purposes, your functional currency is Australian dollar. But you incur transactions in a different currency, maybe in pounds, maybe in South African rand, New Zealand dollar, etc. And how do we account for those transactions in our financial statements here in Australia? So when we look at these transactions, we have to translate these transactions into our functional currency. We have to do it at initial recognition, and we will do it again when we do any subsequent reporting. There are rules around what do we do with exchange differences when we've got transactions, and what are the appropriate disclosures. Now, if you look at examples of foreign currency transactions, you could buy or sell goods in euro, you could incur or settle liabilities in US dollar, you could acquire assets, dispose of assets, in pounds, etc. So at initial recognition, you will take your foreign currency amount, you'll multiply it with the spot exchange rate at that date, and that will give you the amount that will be reflected in your journal entry in your trial balance. So remember, your trial balance in our example is in Australian dollar. If you enter into a loan, on the day that you enter into the loan and you receive your cash, your trial balance is in Australian dollar. You have to reflect that transaction in Australian dollar. So you'll take that foreign currency amount at the spot exchange rate at that date, and that would be the amount that you process in your trial balance. So the date of the transaction, for example, the date of the transaction is the date that the transaction first qualifies for recognition in your trial balance. So it's the date that you process your journal entry. So that would be the date you get control of the asset, or the date that you meet your revenue recognition criteria. So the date that you process this journal entry would be the date that you have to look at your foreign exchange rate. Now, it's interesting when we, for example, look at the purchase of inventory or maybe the sale of inventory. Sometimes we talk about a free on board destination transactions, or we talk free on board shipping point. And these descriptions are really important because it has an impact on the date that you process the journal entry, and the date that you process the journal entry would determine the exchange rate you use. So your first step is to determine the date of the journal, and then you look at the exchange rate at that date. So for example, if you've got a free on board destination, it is often a situation where the seller would incur the delivery expense, and the title of the goods that you've sold passes at the destination to the purchaser. Or if you are the buyer, the seller would incur the delivery expense, and you only get title when you accept the goods at the destination. The other alternative is if you've got a free on board shipping point. And this would be the buyer incurs delivery expense at the point that the goods are shipped or put on the board or put on the ship. And then also often at that point, title will pass to the buyer. So you have to ask, is it free on board destination or is it free on board shipping point? Now, as an immigrant, I can tell you when we came to Australia 20 years ago, believe it or not, we brought our furniture with, and it left Johannesburg in May that year, and 6 weeks later, it arrived in Melbourne. And we know that exchange rates can change quite significantly in 6 weeks. Now, luckily, it was just our own stuff that we've moved, but if it was free on board destination, and it was a transaction, it would be a spot rate 6 weeks later. And if it was free on board shipping point, it would have been a spot rate in May when it left at Johannesburg or left the harbour. I imagine it went to Durban Harbour. So that's initial recognition. Subsequent reporting is where it gets interesting with transactions. Because we've got two different sets of rules. We actually have rules for monetary items and rules for non-monetary items. And if you look at non-monetary items, you know, some non-monetary items are recognized at historical cost, and then you use the rate on the date of the transaction, and other non-monetary items could be fair valued from time to time. And then you have to use the rate on the date that you've determined the fair value. So if you fair valued your property, plant and equipment in 2019, you'll use the rate in 2019. Now, monetary items, you use the closing rate or the rate at your reporting date. The closing rate means the rate at the reporting date. So you can see different rules for monetary, non-monetary items. And therefore, because there's different rules for monetary and non-monetary items, it's important to know the difference between monetary and non-monetary items. So if you've got a monetary item, it is where the units of currency held and the asset and liabilities to be received or paid is in a fixed or the determinable number of units of currency. Now, that's a mouthful. So the right to receive or the obligation to deliver is a fixed number of currency units. So the items which are represented as monetary items have a fixed amount of currency. So for example, if you look at a debtor, you are going to receive a fixed amount of cash in respect of that debtor for the goods or the services that you've previously delivered. You know this debtor owes you a fixed amount, and it's not saying a fixed amount of your functional currency. It says it's a fixed amount of a foreign currency unit. You know this debtor owes you 300,000 South African rand. That's not going to change. It's never going to be more than 300,000 rand. It's never going to be less than 300,000 rand. However, the ultimate amount of Aussie dollar you receive is going to be different, but that's not the problem. It is that foreign currency amount fixed or not? So with cash, if you've got cash in a bank account overseas, it's a fixed amount of that foreign currency. It could be with pension and other employee benefits, it's a fixed amount that you have to pay that person in a certain currency, or provisions that have to be settled in cash. So it's a fixed amount, important, of a foreign currency. We know what amount of foreign currency we have to pay or we have to receive or we will be receiving. Now, a non-monetary item is different. And I've added there under the first bullet point, the second equal, I've added, and that is the value changes in accordance with the use of valuation techniques or the use of other estimation methods. So you know the value of your intangible asset or goodwill or property, plant and equipment or your inventories, those values can change based on the estimation methods you use or the valuation techniques you use. You know, so it is a question of, it's not as if you know what is the fixed foreign currency that you're going to get. It could be very different over time, and therefore they are non-monetary items. So the value of these items are not permanently determined. It's not permanently determined similar to amount of cash that we know the foreign currency you're going to get, or a debtor, you know the foreign currency you're going to get, or a loan, you know the amount they're going to repay. Right, so the value is actually unknown. Oh, no, the value is known, but it could change based on different valuation techniques or estimation methods. So if you look at subsequent reporting dates, this is where the issues come. Remember, initially all at spot rate, but subsequently, if you've got property, plant, and equipment that are measured at fair value under IAS 16, you'll translate it at a rate at the date on which the asset was last revalued. If your property, plant, and equipment is measured at historical cost, you'll translate at the date the rate on you'll translate the rate on transaction date. So if it was acquired in 2009, you'll use the rate at 2009. Now, inventory is an interesting one because inventory is a non-monetary item, similar to property, plant, and equipment. And I just want to say this, inventory is often a problem. I see people get inventory wrong the whole time. Inventory is a non-monetary item. Therefore, if inventory is accounted for, or inventory is accounted for at the lower of cost and net realizable value. So when you look at cost, you look at the carrying amount. When you look at net realizable value is determined at reporting date. So you use the rate at the closing date or at reporting date, and the difference will be a write-off. A lot of people make the mistake in practice that they treat inventory like a monetary item, and they remeasure inventory at every reporting date. You don't do that. You only consider the closing rate for the NRV calculation in order to work out whether you should write off inventory or not. The normal rule, if your inventory is still kept at cost, it will be the cost at the historical rate. So this is a problem. Market, make sure you get it right in practice. And then when we look at these transactions, if you look at gains or losses on non-monetary items, it is important to note if you've got exchange differences on monetary items, they go to P&L. However, if we've got gains or losses on non-monetary items, it depends on what you've done with the gain or the loss. Because if the gain is a revaluation gain, and that revaluation gain under IAS 16 goes to equity, then that foreign exchange gain would also go to equity. However, if the gain or loss is recognized in profit and loss, then the foreign exchange associated with that gain or loss will also go to profit and loss. That is in accordance with paragraph 30. If we look at subsequent reporting dates, paragraph 23, what about impaired assets? Non-monetary assets that are measured in a foreign currency, if you want to do the impairment testing of these assets, you would say, I look at the cost or the carrying amount at the rate on the date that amount was determined. So for example, if this item is at cost, I'll look at a historical rate. If this item is at fair value, I'll look at the rate at the date of the valuation. But remember, when you look at a net realizable value, or if you look at a recoverable amount under IAS 36, you will use a closing rate, the rate at reporting date. So again, you can see when we look at foreign currency transactions and how to translate them and how to do impairment testing, it's not always that easy. So this rule is very similar to the rule we've got on inventory, because as you know, the impairment rules in IAS 36 follow somewhat similar a somewhat similar approach and principle than the principle in IAS 2, where we recognize inventory at the lower of cost and net realizable value. And that's why these follow a very similar approach. Again, if we look at the recognition of exchange differences, if it's related to monetary items, it would go to profit and loss. And your exchange difference is if there's been a change in the rate between transaction date, reporting date, settlement date. I just want to come back to the slide. So when we look at exchange differences in respect of monetary items, it's easy, it's profit and loss. If it's non-monetary items, you have to think a bit harder and think, what did we do with the underlying gain or loss? Did it go to equity or did it go to profit and loss? And therefore the exchange difference will follow that. So that's important. If we move on and we look at translation of a foreign operation, so exchange differences on a monetary item that forms part of a net investment in a foreign operation, those are discussed in paragraphs 15 and also 44 to 49. So if we look at the net investment in a foreign operation, that is the amount of a reporting entity's interest in the net assets of that operation. And remember, it could be the net assets of that branch. So a foreign operation could be a subsidiary, associate, joint venture, or a branch of a reporting entity. And important, the activities are based in a country or currency other than those of the reporting entity. So we've got a foreign operation when it's a subsidiary, associate, joint venture, or a branch, and activities are based in the country or currency other than those of a reporting entity. Now, in practice, you can see I've put there the words activity, or the word activities is in bold, because in practice, we often have difficulty around that particular word. If you have a subsidiary or a branch in another country, but they don't have activities, then you don't have a foreign operation, right? So a foreign operation is not only having a branch in another country or having a branch that operates in a different currency. That branch or that JV actually needs activities. So in practice, it's often hard to consider what are those activities. Do we have activities? Because especially with COVID-19, you might have had activities in the past, but now there could be a discontinuation of activities. Another alternative, maybe the activities have just been temporarily suspended. So, at what stage do we argue we no longer have a net investment in a foreign operation? What extent of activities do we need? Would a temporary halt of activities, stop this? How long is a temporary halt of activities? Very judgmental. So if we look at this net investment in a foreign operation, and let's say we establish we do have a foreign operation, we have activities, and we have that net investment, if an entity has a monetary item that is neither planned or likely to be settled in the foreseeable future, and that could be maybe there's a loan, there's a receivable, trade payable. So it has to be a monetary item. So if you've got monetary items and that it's not planned or it's not likely to be settled in the foreseeable future, you would say in substance, that monetary item is actually part of the entity's net investment in a foreign operation. Now, if you argue that, an example of that is, let's say entity A has a subsidiary X, and entity A grants a loan to subsidiary X. So, entity A has a loan receivable from the subsidiary. One could assess and say, do we think this loan receivable from subsidiary X is part of our net investment in that foreign operation or not? And we will say, listen, if settlement of that loan is not planned and actually not likely to occur in the foreseeable future, one would argue that loan receivable is potentially part of our net investment in that foreign operation. So, if you look at a net investment in a foreign operation, why would you try and argue that these monetary items are part of the net investment in a foreign operation or not? It has an impact on how you recognize exchange differences. Because if you've got exchange differences on monetary items that form part of that net investment in a foreign operation, one would argue in the separate financial statements of the parent and the foreign operation, changes will go through the P&L, but on consolidation, this is the benefit, it will actually be part of equity. It will be a separate component of equity or other comprehensive income called a foreign currency translation reserve. So those exchange differences that are part of this net investment in a foreign operation could end up in equity in the consolidated financials, and that's the benefit that we achieve. In the separate financials of the parent and the foreign operation, still P&L. The other thing to remember, if you argue that this monetary item is part of the net investment in the foreign operation and you've considered everything, that's your judgment. And if on consolidation, therefore, you put the exchange differences to a foreign currency translation reserve in equity, once you sell that net investment in the foreign operation, all of those exchange differences have to go to P&L. And the other thing is, it could also happen that maybe during COVID you've abandoned the foreign operation, or maybe you no longer have activities, and then again, all of that should go to P&L. So it's something to look at very carefully. How to account for exchange differences around monetary items that form part of a net investment in a foreign operation or not, and whether it is part of that net investment or not, is quite problematic. In practice, an area to look at and look at very carefully. Another item to look at, or the third part, is presentation currency. So it could be that an entity wants to present its financial statements in a presentation currency that's not the same as its functional currency. Now, earlier today, I've clearly explained that functional currency is not a choice. You look at facts and circumstances, apply the standard, apply your judgment, and you determine functional currency. Presentation currency is different. Presentation currency is a choice. So you can decide in what currency do you want to present your financial statements, which would often be driven by where do you want to attract money from an investment perspective. Who are your stakeholders? Who are your potential investors? So it's a free choice. Presentation currency is a free choice. So your functional currency is based on analysis. And then you could decide, I want to move to a completely different presentation currency. How do we do that? And that is where we look at the requirements of paragraph 38 to 43. So in this example, I've just had revenue, expenses, everything, assets, liability. I've got it in US dollar, and I've put a rate in of 80 cents to get to the Aussie dollar. And I've just applied the 80 cents to everything, assets, liability, income, expenses, everything. Now, that's not right at all. The standard actually says that some foreign currency balances are intrinsically more exposed to foreign exchange movements than others. So, for example, cash, trade payables, trade receivables, a foreign denominated debt, are intrinsically more exposed to foreign exchange movements. And therefore, to reflect the exposure of these balances to foreign exchange movements, IAS 21 requires them to be translated at the reporting date spot rate, notwithstanding that they might never actually ever be converted into this presentation currency. So this is the reasoning why we translate these at spot rate. So in my example, we would translate, revenue, expenses, non-monetary items at the historical rates, quite often an average rate for the year. When you look at revenue and expenses, non-monetary assets, you look at the historical rate again, but monetary assets and monetary liabilities, you will use the closing rate at reporting date. And then you'll see there's a difference. If you do it this way, you could have a difference. It doesn't work out nicely the way I've initially done it. Remember, that was just to illustrate that it's wrong. Here, I'm doing it correctly under IAS 21, and I've got a difference of 7. And what do we do with that difference of 7? That difference of 7, and I'll come back to that, that difference of 7 will go to a foreign currency translation reserve. Another example where we might go from functional currency to presentation currency is in a group perspective. So there's two things that could happen. You could have you yourself have a functional currency of Aussie dollar, and you want to present in US dollar. That can happen. I've looked at that. It could also be in a group perspective where the parent has an Australian dollar functional currency. Subsidiaries have different functional currencies. And from a group perspective, in order to do consolidated financial statements, we use our functional currency. The parent has a functional currency of Australian dollar. We want to do consolidation in Australian dollar. That is the presentation currency of the group. And therefore, you have to first convert the subsidiaries' financial statements from their functional currency to Australian dollar, and then you can consolidate at a group level. So that's another way where we could see it. So again, assets and liabilities, if you translate into a presentation currency, assets and liabilities would go at a closing rate, income and expenses on transaction date, so potentially an average rate. Exchange differences would be recognized in equity. So it's in equity and not P&L, because the changes in the exchange rates have little or no direct effect on the present and future cash flows from operations. We only put these financial statements together in a presentation currency for presentation purposes, and therefore, it shouldn't impact P&L. The other thing I should touch on is hyperinflationary economies. There's a separate standard for hyperinflationary economies. The ones that over the last number of years we know are hyperinflationary economies. Some examples would be Argentina, Iran, Lebanon, South Sudan, Venezuela, Zimbabwe. Hyperinflationary economies would be countries with a 3-year cumulative inflation rate exceeding 100%. And that's why, these countries would have been classified as a hyperinflationary economy. Therefore, there's very specific rules. If you've got a subsidiary in any of these countries, you use a different standard in order to do the conversion to presentation currency. So if the entity's functional currency is in a hyperinflationary currency, you restate your financial statements in accordance with IAS 29 or AASB 129 before you'd even apply the translation methods in paragraph 42. Basically, all amounts are converted at closing rates, and comparative amounts are not adjusted for subsequent changes in price levels or subsequent changes in exchange rates. If we look at IAS 21, finally, we've reached 12 p.m. in Melbourne. I've put in some disclosures, references to disclosure requirements on how do we disclose the amount of exchange differences in P&L, how do we disclose exchange differences that were recognized in other comprehensive income, OCI, and equity. I've also included disclosures on when the presentation currency and functional currency are not the same. You have to disclose the fact and the reason for using that different presentation currency. You can do it, but you have to disclose it. And when there's a change in functional currency, again, disclose the fact and the reason for the change. And it's important that you disclose under AASB 101, paragraph 51D, or IAS 1, paragraph 51D, disclose the presentation currency that you've used. Finally, I think today we've kept to the time. I'm very proud of myself for keeping to the time for a change. If you need any assistance, first of all, again, please register for our webinars in 2022. All 12 of them have been scheduled. You can see the topics that's been scheduled. But if relevant things happen, we'll incorporate, like we did with COVID-19, register for our monthly accounting news. And then, if you need to speak to any of our IFRS leaders, please feel free to reach out to any of us. I've included all our contact details. Please reach out to us or any of our broader team. Then finally, I would like to say to all of our regular webinar attendees, thank you very much for joining us on these webinars every single month. We really appreciate it. Please, I hope you get everything done you want to do within the next week or so you can get some time off over Christmas and the New Year. Please stay safe and healthy. And if you celebrate Christmas like I do, Merry Christmas, and we look forward to speaking to you in the new year.